Are you wondering when the Federal Reserve will cut interest rates? Will they hold or raise them? Will employment increase or decrease? And what will happen to inflation? After watching the latest statement from the Federal Open Market Committee, FOMC, you're even more confused. Don't worry. I'm here to help you understand the important implications behind these moves, as quantitative easing QE moves faster than many expected. I'm Joe Brown. I've been a stockbroker for a while now, running Heresy Financial, where I help investors proactively manage risk in their portfolios while enhancing long-term returns. If you need help with this, check out the video description for more details. One way to understand the Fed's direction is to compare the differences in their statements from meeting to meeting. Let's take a closer look at that now. The unchanged text remains in black, while the superseded or no longer appearing text is crossed out. The uncrossed red text is what was added to the recent statement. Immediately, we see that the phrase recently has been replaced with, although changes in net exports have affected the data, followed by the statement that recent indicators suggest that economic activity has continued to expand at a steady pace. This refers to the recent GDP decline as the economy has been hit by a trade deficit, especially in Q1, when imports surged to get ahead of the new tariffs. The Fed recognizes this volatility in net exports and sees GDP growth as largely driven by short-term changes in trade, which it appears to be underestimating. This means that the unusually high imports in Q1 will be offset in subsequent quarters. Essentially, the purchases have been condensed into one quarter and will rebalance over subsequent periods. There are also some other notable changes in the statement, such as changing the phrase uncertainties surrounding the economic outlook to uncertainties about the economic outlook, and adding that these risks have also increased. Here, the Fed emphasizes that the committee is mindful of risks to both sides of its dual mandate. This time, it adds that the risks of higher employment and higher inflation have increased. This is important because employment and inflation are often two opposing sides that the Fed must balance to achieve its goals. If the Fed wants to boost employment, it often uses its monetary policy tool. Raising interest rates can encourage saving and reduce spending, but it can also slow economic growth. Conversely, lowering interest rates stimulates borrowing, spending, and investment. Expanding the balance sheet puts more money into the system to boost the economy, while shrinking the balance sheet does the opposite by taking money out of the system. When the money supply increases, it boosts economic growth, creating more jobs, but it also pushes prices up. If the money supply is tightened, economic activity slows down, dragging down employment and inflationary pressures. The Fed admits that it is in a difficult position. Further easing will cause prices to rise, but tightening again could push unemployment higher. The Fed is facing delicate decisions because every move now carries significant risks for the economy as a whole. So this is a significant change, and we'll come back to it later. Again, there's no significant change in the way they announce that they're keeping rates where they are and that they're going to carefully evaluate the inputs. However, they did remove the entire explanation for the decision to slow the pace of quantitative tightening. Here's the Federal Reserve's balance sheet, which is where they store the assets they bought during QE. For example, in 2020, they bought a lot of government bonds and mortgage-backed securities, all of which went on the balance sheet. Then, starting in 2022, they started to put some of that debt into liquidation, which gradually reduced the size of the balance sheet. If we look more closely at the trend over the past year, we can see that over the past month, the rate of reduction has slowed. This is entirely consistent with their recent statements. Policy transitions are typically done very slowly, unless there is a particular emergency. In recent years, the Fed has been draining liquidity from the system through quantitative tightening, while also reducing the size of its balance sheet. But they are now gradually ending this process. For the next few months, it is likely that the balance sheet will not change significantly. Debts that mature or are paid off will be transferred directly back into the system. This means that their assets will remain roughly the same. After that, the trend may shift to reactivating QE, which will increase the balance sheet again. However, in order not to stray too far from current expectations, the rest of the statement is largely unchanged. They only emphasize that they are ready to adjust monetary policy if the economic data requires it. There were also some minor changes to the voting composition at the recent meeting. So why do I think we will see a rate cut and a return to QE in the next 2 quarters? It is largely based on the current inflation reading. while the Consumer Price Index, CPI, remains high. Other measures of inflation in the U.S. are actually slowing significantly. This makes sense because when the economy is in recession and prices are falling, or when government tariffs increase the price of some goods, consumers will have to spend more on those goods and have less money for other goods. They may even be forced to look for less attractive quality or price alternatives to meet their needs. This suggests that tariffs are not generally inflationary. They do raise the prices of some goods, but not enough to push up the overall price index. Conversely, because they create a drag on economic activity, the effect of tariffs is often deflationary. This data will be included in the official data soon, probably in the next 3 or 6 months. However, the Federal Reserve, Fed, will no longer face the dilemma we mentioned before, where they have to choose between worsening employment or worsening prices. With the economic conditions deteriorating due to recession, trade wars, and tariffs, prices will naturally fall. Therefore, they will no longer have to worry about inflation because it will be resolved by the recession itself. This means that the Fed can focus on dealing with recession and rising unemployment through economic stimulus measures. In the coming months, with the pressure of the economic downturn, the Fed will likely return to quantitative easing, QE, policies and cut interest rates when inflation concerns are no longer a central issue. Over the long term, this suggests that the long-term debt cycle that I have been talking about is continuing. At the current stage of the long-term debt cycle, we are seeing higher interest rates and rising inflation as the government gradually reduces its leverage relative to the size of the economy. However, there are still short periods in the cycle where interest rates and prices are falling. This is likely what is happening right now and will continue for the next quarter or two. However, 2020 marked the end of the final stage of the long-term debt cycle. It marked the end of the long trend of gradually decreasing interest rates, the end of the government's leverage relative to the economy, and the end of the long trend of deflation. That means we will no longer see 0% interest rates or 2.5% mortgage rates. In the short term, there may be a brief breather down period in the next few months, but in the long term, be prepared for higher interest rates to persist for a long time. If you need help implementing these strategies into your investment plan to ensure the safety and growth of your portfolio during times of economic volatility, please visit the links in the description below. As always, thanks for watching. Have a great day.